Interest rates in the United States have now been above 4% for almost a year now. This comes after an increase in interest rates from 1% all the way up to 4% in just a couple of years, one of the largest increases in interest rates we've seen since the 1970s. Back then, rising interest rates like we've seen today systematically triggered economic recessions, 4 of them occurring between 1968 and 1983, and most of these were accompanied by vicious stock market corrections between 20 and 50% in size and often lasting multiple years. Today, not only are interest rates hovering at the highest level in over 15 years, they're staying much higher and for much longer than what we thought and what most people would have ever thought possible just a few years ago, when the Federal Reserve was promising that they would keep interest rates at 0% until at least 2023. But as we're going to discuss, they don't look like they're about to come down just yet. And despite all of this, the U.S. stock market is making new all-time highs, substantially different behavior to what we saw in the 1970s during these periods where interest rates were at high levels. Of course, one major difference between today and the 1970s is that we saw a series of oil shocks between 1968 and 1980 that caused the price of oil to go up from $3 to $40 during that time frame. These oil shocks were the primary reason for the inflation waves that we saw in the 1970s, and they were also the primary reason for why the U.S. economy experienced recessions back then, immediately crushed the U.S. consumer and precipitated these downturns. Today, we of course see no oil shock. Oil is down 35% from its peak today, which actually helps the consumer a great deal. We even currently have a short trade on oil on our website because we think the weakening global economies is going to drag oil prices lower from here. And currently, the technicals suggest that there is strong resistance overhead, that momentum is turning back down, and that if oil breaks the $69 level, it could set off a much larger move down in oil prices. But despite these lower oil prices, interest rates have continued to climb higher over the last 2 years, and these, on the other hand, are having a big impact on the economy right now. Higher interest rates are making housing much less affordable. This is a survey that shows what people think about housing affordability today, lowest levels in history. It's comparable to the poor readings that we also saw in the 1970s and 80s. During these periods of high interest rates, when people feel less confident about the housing market, it often impacts their spending and it leads to recessions. At least that's what happened in all of these instances that you see right here. But it's not just housing that's feeling these high interest rates. Small businesses in the US are also impacted. They're finding it more and more difficult to borrow money. This is a chart showing us the number of businesses saying that it's more difficult to take on debt today. And just over the last couple of years, we've seen that climb much higher. In the past, when we've seen these types of moves up in these surveys, it also often led to recessions. Now, again, just because it happened in the past doesn't mean it's going to happen again. But we do see that this is impacting the way that businesses are behaving today. Take a look at this chart, for example, that shows us how much businesses are looking to hire new workers. And look at what happened recently. This is dropping like a stone. Less and less businesses are looking to hire new workers. Again, in the past, this has led to recessions. So it's undeniable that this is a sign that the economy is being impacted by high interest rates, even though we're not in a recession right now. And I want that to be very clear. Just because we're seeing signs that the economy is weakening doesn't mean that we are in a recession today. Because when we look at the positive data, people are spending like never before. This is a chart of personal consumption expenditures. It's basically how much people are spending, and this is adjusted for inflation. And since 2021, this line has been just a straight line up, and it's keeping track of very healthily at the same level of spending that we saw between 2010 and 2020, which were not at all recessionary conditions. In fact, the stock market during that period went up considerably. This is what the 2008 recession looks like. We don't look anything like that right now. Now, we did think that the fiscal stimulus that was injected during the pandemic would have waned off by now, but that's not the case. For all intents and purposes, the US economy is booming today. We just have signs that this uptrend might weaken in the near future. And by the way, this was December of 2007. The stock market peaked right here. That's the very month that people stopped spending. So as long as people continue spending, the stock market is going to continue going up right? Well, we know that's not the case because in 2022, we saw a 25% drop in the stock market, and that happened at the exact same moment as interest rates were rising very aggressively during that period. In fact, when we look at the price action of the stock market in 2022 in a little bit more detail, and we put interest rates on top, but in reverse, we see a perfect correlation between the stock market and what interest rates were doing in 2022. And that makes perfect sense, right? As interest rates are rising, investors are getting a better yield on cash and debt. And so that mechanically puts downwards pressure on the market's valuation. It wasn't until the end of 2022, where interest rates stopped rising as quickly as they did before, that the stock market finally began to rally. Now today, because of large cap stocks like Microsoft and Nvidia, the divergence between the stock market and what bond yields are doing has grown, but the relationship is still very much intact. In fact, in September and October of 2023, the S&P 500 experienced a 10% correction that was primarily fueled by bond yields rising. And the massive rally in the stock market that we've seen since October was initially primarily fueled by interest rates coming back down. But more recently, we've seen the stock market rally, while interest rates, on the other hand, have been rising. That's actually a very similar setup to what we saw in July and August of 2023, where the stock market was rising as bond yields were also rising. Eventually, interest rates rose too much, and the stock market began that 10% correction. We think there's a similar risk to the market today, where if bond yields continue to spike, that the stock market would eventually need to snap back to reality like it did in the summer of 2023. We do currently have a short trade on the S&P 500 right now on the website based on this setup, but now it's only a very small allocation because the S&P 500 is still trending above a key trend line that you see right here. And until we have confirmation that this trend line has been broken, we think it's a bit risky to be allocating a large short position on the S&P 500. Back in August of 2023, we had a very similar setup where the S&P 500 was trending higher within this type of a wedge, and the uptrend finally came to an end when it broke below that trend line. Now, the big risk to this trade is that interest rates all of a sudden begin to move back lower, which could happen if inflation stops showing signs of being stubborn, and that could get the stock market extremely excited. But we think there's a considerable chance that we see another spike in interest rates here. The last inflation number came in at 3.2%. Now, that may not look very worrying, but it's significantly above the Federal Reserve's target of 2% inflation. If inflation continues to stagnate here, it could be that the Federal Reserve decides to keep their interest rates at the same level as it is today. Now, when we add long-term interest rates on top of this chart, we see they are heavily influenced by what the Federal Reserve is doing. And the longer the Federal Reserve keeps its interest rates at these elevated levels, the higher the risk that we see another spike in these long-term interest rates. And that is exactly what happened in the summer of 2023, where we had this spike in long-term interest rates. The market is not immune to seeing another one of those again.